Well, basically our view has not too much changed. We still think that if anything, the Fed will hike rates actually later than what the market is expecting currently, which means that it's going to take place later than the first half, the mid-year next year. Reasons are simple. There's two reasons. The first one is that the unemployment rate is no longer the sole criteria that the Fed is considering in terms of tightening rates. The second thing is that you've got those two new factors, which one is the US dollar appreciation. The second one is the inflation trend, which is currently missing. To combine all the three together and get an acceptable situation in which the Fed can hike will probably take more than 9 months. And so we think that any rate hike will be actually postponed probably to the year end. And so in that context overall, this is quite positive to the risky asset class across the financial world. And so we remain positively invested in risky assets such as equity. Well, in terms of flow, I mean, if you see there's been a bit of a correction of late, we think that this is a good entry opportunity. We definitely think that the US equity are still offering a very good prospect. We are a bit more cautious on Europe. We think that it will take a bit more time actually to see Europe recovering. They will benefit from this acceleration out of the US. They will benefit from the weaker euro. They will benefit from the weak oil prices. But it will take probably 3 to 6 months to materialize. So you want to be invested first in the US and then at a later stage pick up Europe. In the emerging world, we think that there are two big beneficiaries of that low oil price context, which are India, and that's a clear winner, and then China to a certain extent. And so for that reason, we are overweight those two countries within the emerging world.